Welcome back to another deep dive.
Yeah.
Today we are tackling a subject that I feel like absolutely everyone has an opinion on, but if you really press them, very few people could actually, draw you a map of what they're talking about.
That's a great way to put it.
We are diving into the messy, chaotic, and frankly, overwhelming world of cryptocurrency. But here's the promise right up front. We are moving way past the basics. We aren't just talking about Bitcoin today.
Right, because in a lot of ways, Bitcoin is actually the easy part. It's established. People call it digital gold. And most people, even if they are skeptical, can kind of wrap their heads around that concept. It's scarce, it's digital, you hold it in a digital vault, and hopefully the number goes up over time.
Exactly. You get the orange coin concept. It's simple enough. But then you open up a crypto tracking app, or you look at the financial news ticker, and you don't just see Bitcoin. You see a list that just keeps scrolling.
And scrolling.
And scrolling. There are literally thousands of other coins. You've got dogs, you've got weird food names, you've got these three-letter acronyms that sound like, I don't know, government agencies.
Right.
And the central confusion we want to clear up today is this. If Bitcoin is digital gold, what on earth is everything else?
That is the multi-trillion-dollar question, isn't it? And it's the source of almost all the anxiety people feel when they approach the sector. They see that wall of names and just shut down.
It really is. I think for the average person, let's say the learner who listens to this, the experience is just overwhelming noise. You see these thousands of tickers, and you have to wonder, are these all money? Are they all competing to be the next dollar?
Is everything that isn't Bitcoin a scam? That's the other big one.
That's the big one. And honestly, why does the word crypto seem to describe 10 totally different things at the same time? It's used for everything.
It's a linguistic mess, honestly. We use this one bucket term, crypto, to describe currency, a piece of art, a voting share, and a casino chip, all at once. And that's what we are going to fix today. Our mission with this deep dive is to strip away that noise. We are going to build a clean, jargon-free mental model of the entire landscape.
Okay, so we're building a map. We're going to define what crypto actually means when it's not just Bitcoin. We'll talk about the massive difference between coins and tokens, which I have to admit I didn't realize was such a big deal until we started prepping this.
It's the most important distinction, I think.
And we'll get into the nuts and bolts of how these things actually work.
And we are assuming a little bit of prior context here. So if you were with us for our Bitcoin deep dive, you know the basics. You know that mining and the blockchain are essentially tools to prevent double spending.
Right. They stop people from copying and pasting digital money like it's a Word document.
Exactly. The integrity of the ledger is solved. We know the how of that. Today is about the what. What are we actually building on top of that ledger? We're talking about platforms like Ethereum and concepts like DeFi and NFTs, the whole ecosystem.
So let's unpack this. Let's start with the definition itself, because that seems to be the root of the problem. When we say cryptocurrency in this broader sense, what are we actually talking about?
Well, if you look at the strict technical definition, it's a digital asset transferred on a network using cryptography. And usually that network is a blockchain or some other kind of distributed ledger.
Okay, but that feels a little dry and honestly a little vague. A digital asset could be a photo I email you. It doesn't tell me why it matters or why it has value.
Precisely. It's not a very useful definition in practice. That's why I prefer the practical definition. I want you to think of cryptocurrency not just as internet money, but as the tool you use to pay for security and coordination on a decentralized network.
Security and coordination. Okay, that's a very different framing. It sounds more like a utility bill than a currency.
It often is. And that's the key. Because sometimes, yes, it behaves like money. You pay for things with it. You send it to a friend. But other times, that same crypto asset is acting like fuel like gasoline to power a computer program. Or sometimes it's a voting chip that lets you and other people govern how a piece of software works. And then sometimes it's just a receipt that proves you own a specific digital item.
So it's like a shapeshifter. The token or the asset, it morphs its function based on what you're doing with it at that moment.
In a way, yeah. And that explains why the conversation around it is so confusing. You might have one friend who says, oh, I'm into crypto. And what they mean is they are investing in these digital assets like a stockbroker. They're just watching charts.
Right, buying and selling.
But then you have another friend saying, I'm into crypto, and they're actually using decentralized applications to take out loans or trade derivatives without a bank. They're a user of the technology.
And a third person is just, trading meme tokens with dog pictures on them or building the software itself.
Or just posting memes on the internet hoping to get rich.
Yeah.
It's one word describing totally different human activities. But they all rely on this underlying technology of decentralized coordination.
Okay, I want to drill down into the biggest source of confusion I see. I open a tracking site, I see 10,000 assets. How do I even begin to categorize them? You brought up this distinction between a coin and a token in the notes. I think this is the most useful mental model for a beginner to grab onto.
I agree completely. If you only take one thing away from this entire deep dive, let it be the distinction between a coin and a token. Because the media, the news, they get this wrong constantly. They use the terms interchangeably.
So lay it out for us. How do we tell them apart? What's the model?
The best analogy I found is the smartphone. I want you to think of a blockchain network like the Bitcoin network or the Ethereum network as the operating system. Think of it like iOS on your iPhone or Android.
Okay, so the blockchain is the OS. It's the platform, the foundation.
Correct. Now, a coin is the native asset of that operating system. It's part of the core infrastructure. It lives on its own blockchain. So Bitcoin, BTC, lives on the Bitcoin network. Ether, or ETH, lives on the Ethereum network. SOL lives on the Solana network.
And what is the specific job of that coin? Why does the OS need its own special currency?
Its primary job is to pay for the maintenance of that operating system. It's the oil in the machine. You use the coin to pay transaction fees. You use it to pay for network security. That's the mining or staking we'll talk about later. And to incentivize all the people around the world who are running the computers that keep the network alive.
Got it. So the coin is the native currency of the land. It keeps the lights on. If you want to play in that sandbox, if you want to use that operating system, you have to pay the entry fee in that specific native coin.
That's a perfect way to put it. Now compare that to a token. A token doesn't have its own blockchain. It doesn't have its own operating system. It lives on top of an existing one. So going back to our analogy, if the blockchain is the smartphone OS, the token is an app that you build on top of it.
Oh, that clicks immediately. So when I see all these thousands of random names on a list, they aren't all trying to build their own global network of computers from scratch.
No, absolutely not. Thank goodness. The vast majority, probably 95%, maybe even more, are tokens. They are applications relying on a few major platforms. A token represents something inside a specific application. It could be a currency for a game. It could be a voting right for a club. It could be a share in a project. Or it could be a collectible, like an NFT.
So just like I can download thousands of apps on my iPhone, but they all run on iOS and use Apple's infrastructure.
Yeah.
Developers can launch thousands of tokens, but they're almost all running on Ethereum or Solana or one of these other foundational blockchains.
Precisely. And that's why you see so many assets popping up. Creating a new secure blockchain, a new coin, is incredibly hard. It takes years of world-class engineering, massive resources, and you have to convince thousands of people to run servers for you. It's a monumental task.
But creating a token.
Creating a token. You can literally do that in an afternoon if you know the code. There are templates for it. It's like building a website instead of building the entire internet.
That is a huge distinction, a game changer for how you view the landscape. So when we look at the market, we aren't looking at thousands of competitors to Bitcoin. We are looking at a few operating systems and then thousands and thousands of apps running on them.
That's the perfect way to visualize it. And it completely changes how you should think about valuing them. You value the OS based on how many people are building on it and using it. Its value is in its utility as a platform. You value the token based on what that specific app actually does and whether anyone wants to use it.
Okay, that clears up a lot. So moving on, we've got the structure OS versus app, coin versus token. But let's get to the why. Why are we doing any of this in the first place? You mentioned earlier that crypto is for security and coordination, but why do we need a blockchain for that? Google coordinates my calendar pretty well. My bank coordinates my money pretty well. Visa processes thousands of transactions a second.
This is the core question. This is the question you have to ask yourself whenever you look at any crypto project. What is this network trying to do without trusting a central authority?
Right. Because traditional tech, Web 2, it works great if you trust the boss.
Exactly. Traditional servers, the ones run by Amazon, Google, your bank, they are fast, they are cheap, and they are incredibly efficient. If you trust the company running the database, you don't need crypto. Crypto is specifically for the times when you need transparency and rules that are enforced by code, not by a company's terms of service that could change tomorrow without you even knowing.
It's for when the cost of trusting a middleman is too high or the risk is too great.
Yes. Or when there is no natural middleman to trust. The source material we looked at highlighted 5 main problem areas these networks are trying to solve. I think running through them makes this much more concrete.
Yeah, let's do it.
Okay, the first one is the most obvious, payments. This is the original Bitcoin use case. Transferring value globally, across borders, without a bank in the middle. It's about censorship resistance.
Right. Simple enough. Digital cash. What's number 2?
Programmable contracts. This is where things start to get really interesting and move beyond just money. This is about executing logic, if this, then that, without a middleman.
We'll dig deeper into that when we talk about smart contracts later, but that sounds like replacing lawyers or escrow agents with code.
In some specific instances, yes. It's about the automation of trust. The third area is digital identity and reputation. Think about proving facts about an account, like your creditworthiness, or that you graduated from a certain university, without necessarily revealing all your personal data to a centralized giant like a credit bureau who might then leak it.
That's a huge one given all the data breaches we see.
Yeah.
I feel like every other week I get an email saying your data was part of a compromise.
Exactly. In this model, you hold your own credentials, your own data, and you choose what to reveal. 4 is asset issuance. This is simply creating and moving tokens that represent ownership of something.
So like a stock or a deed to a house.
It could be. It could be a stock, a deed, a piece of art, a concert ticket. It allows anyone to create a verifiable digital asset that can be traded globally 2047. It, in theory, democratizes the ability to create and exchange value.
And the 5th and final one.
Coordination. And this one is maybe the most abstract, but also the most ambitious. This is about groups of strangers making decisions together, managing a treasury, voting on rules for a piece of software, all without a CEO or a board of directors controlling the central database.
It's basically trying to build a digital democracy for an organization.
It's organization without hierarchy. That's the dream, at least. You'll hear the term DAOs, decentralized autonomous organizations. That's what they're trying to be.
Okay, so we have these goals. We want to coordinate strangers, move money, and execute contracts, all without a central boss. But that creates a massive, massive problem, doesn't it? If no one is in charge, how do we agree on what's true? If I say I have $1 million and you say I have 0, who decides who is right?
And that brings us to the next layer of our model, consensus. How do strangers agree on the truth? In a centralized system, it's easy. The bank's database is the truth. The bank says you have $50. Well, you have $50. End of story.
Right.
In crypto, we need a mechanism where the whole network of disconnected computers can look at the state of the world and all come to the same conclusion about who owns what.
And this is where we start hearing those technical terms that scare people off, like proof of work and proof of stake.
Right, and they get thrown around technically, but I want you to think of them as economic systems. They're just different ones of answering one single question. How do we make cheating more expensive than being honest?
I love that framing. It's not about morals, it's about pure economics.
It's pure game theory. So let's quickly recap proof of work, which is the model Bitcoin uses. In this system, so-called miners compete to solve incredibly difficult math puzzles using specialized computers.
And doing that requires a ton of electricity.
A ton of electricity. They have to spend real-world resources, energy, and powerful hardware. The first one to solve the puzzle gets to add the next block of transactions to the chain and gets a reward.
So if I want to hack the network and rewrite history, say, to erase a payment I made, I would have to redo all that work. I have to overpower all that electricity being spent by everyone else.
Exactly. The security comes from that sheer physical cost. It is prohibitively expensive to attack the network. You would have to burn billions of dollars in energy just to try to reverse a single transaction, and you'd probably fail. The cost of being honest and just earning the rewards is far, far lower.
Okay, that makes sense. But then we have the alternative, proof of stake, which is what Ethereum switched to and what a lot of the newer networks use. How is that different? It doesn't use all that energy, right?
Correct. In proof of stake, we swap out the external resource of electricity for an internal one, capital. Instead of miners, you have validators, and these validators lock up or stake the network's own native coins.
So they're basically putting down a security deposit, a bond.
Exactly. It's a huge security deposit. They put up their own money as collateral to say, I promise to process transactions honestly and follow the rules. If they propose valid blocks, they get a reward, like interest on their deposit. But if they try to cheat,
The network takes their money.
the network automatically confiscates their deposit. It's an automated penalty. We call that slashing. So the incentive is the same. If you have millions of dollars staked, you're not going to risk losing it all just to approve one fraudulent transaction.
So in proof of work, you secure the network with an external resource, energy. And in proof of stake, you secure it with an internal resource, the value of the tokens themselves.
That's the core distinction. And for anyone listening who's a beginner, you don't need to pick a team. There are endless debates online about which is better. Just recognize that these are two different security models for establishing truth without a leader. One uses physics and energy. The other uses finance and capital.
Okay, so we've established how the network stays secure and agrees on the truth. Now let's talk about what really makes the modern crypto landscape different from the early Bitcoin days. We touched on this, but it's this crucial shift from, as you put it, a calculator to a computer.
Yes, this is the pivotal moment in crypto history, and it's all thanks to Ethereum. Bitcoin is essentially a decentralized calculator. It's very, very good at doing one thing, adding and subtracting balances securely. Alice sends 5 BTC to Bob. Simple, reliable, bulletproof.
But that's pretty much all it does.
That's its focus. But then came Ethereum with this revolutionary concept of smart contracts.
Right.
And a smart contract changes the game entirely. It allows you to upload and run small computer programs directly on the blockchain. So it's not just send money, it's execute this logic. It's if X happens, then automatically do Y.
Can you give us a real-world simple example of how that works? Because smart contract sounds a bit like marketing jargon, but futuristic.
It is a bit, but the concept is old. Think of a vending machine. A vending machine is basically a mechanical smart contract. The rules are baked right into the machine. If user inserts $2 and user selects button B4, then dispense the can of soda.
Right. You don't need a cashier standing there to trust the transaction. The machine just does it.
The machine executes the logic automatically. A smart contract does the exact same thing, but with code on a blockchain. But it can do it for anything, not just soda. It can be, if the user deposits 100 of this token into this contract, then start paying them 5% interest per year, calculated every second.
Right.
Or, if this piece of digital art is sold on any marketplace, then automatically send 10% of the sale price back to the wallet of the original artist as a royalty.
And this runs automatically. There's no accountant, no gallery manager, no one checking it.
Once it's deployed to the blockchain, that code runs exactly as written, forever. No one can change it, no one can stop it, and this capability is what enables dApps decentralized applications.
Okay, so walk us through the user experience here, because this is where people get really confused about logging in and interacting with this stuff.
Right. In the old web, what we call Web 2, you log in to a centralized server. You type your email and your password into Facebook's website. You are asking Facebook's server to let you in. In this new model Web 3, you don't log into a server in the same way. You interact directly with the blockchain's shared computer using your wallet.
My wallet is my identity. It's my login.
Your wallet holds your private keys, which are like your password. They give you permission to move your assets and interact with contracts. So the interaction loop is a user uses their wallet, which acts as their identity and permission slip. They use it to interact with a smart contract, which contains the rules of the application. And the result of that interaction is recorded permanently on the blockchain, which is the shared state for everyone.
And that loop wallet, smart contract, blockchain, is the foundation for pretty much everything we hear about in this space, like DeFi, decentralized finance, and NFTs.
Exactly. DeFi is just financial software lending, borrowing, trading built with smart contracts instead of banks. NFTs are just ownership records for digital or physical items that are managed by smart contracts instead of a registry office or a database.
This all sounds incredible, but it brings us to a huge pain point. A point of friction that I think every new user experiences almost immediately. The fees.
I guess gas.
Gas fees. You go to send $20 to a friend or buy a $5 NFT and the wallet pops up and says that will be $5 in gas fees.
Right.
Or in a bull market, maybe $50. And you just think, wait, what? Why? I thought this was the future of money. Email is free. Venmo is free.
It's a very common and very valid frustration, but you have to understand what you're paying for. Gas is basically a payment for computation and storage. You have to remember, a blockchain isn't some infinite cloud computer.
It's not Amazon Web Services.
Far from it. A blockchain is a global shared computer that has to be kept in sync across thousands of individual machines. It's slow and has very limited capacity by design. Every single transaction, every interaction takes up a little bit of that precious space in a block, and that space is finite.
So when I pay a fee, who am I actually paying? Where does that money go?
You are paying the validators, or miners, the people running the computers. You are paying them to do the work of processing your transaction and including it in the next block. It's also a crucial security feature.
How so?
If transactions were free, someone could just spam the network with billions of tiny, useless transactions and grind the whole thing to a halt. The fee makes those kinds of spam attacks economically unviable.
Okay, that makes sense. It's a spam filter, but why does the price fluctuate so much? Sometimes it's a few cents, and other times it's $50 or more to do the same thing.
It's pure supply and demand. It's an auction for that limited block space. When there is high congestion, meaning lots and lots of people want to use the network at the same time, you have to outbid them to get your transaction processed quickly.
So it's exactly like Uber surge pricing.
It's exactly like Uber surge pricing. If everyone in the city wants a ride home at 5 p.m. when it starts raining, the price goes up. If everyone wants to trade a popular new token at the same time, the gas price goes up.
So it's not the app being greedy. It's not the Ethereum Foundation raising prices on me like a corporation.
No, not at all. It's purely a decentralized market for block space. And you're also paying for something called finality. You are paying for the global cryptographic guarantee that your transaction won't be reversed or censored. That level of security, that digital concrete, costs money to maintain.
All right, let's pivot to the thing everyone stares at all day. The price. The value. Where does the value actually come from? We know why a share of Apple stock has value. It's a claim on the company's future profits. We know why a bond has value. But why does a string of numbers on a blockchain, a digital token, have any value at all?
This is where we have to separate the signal from the noise. Because there are legitimate drivers of value, and then there are, let's call them less healthy drivers, speculation and hype.
Let's start with the legitimate ones. What fundamentally makes a digital coin or token worth anything?
The first and most important one is utility. If you need a specific coin to use a network, like we just discussed, you need ETH to pay for gas on Ethereum. That creates a baseline, non-speculative demand. If people want to use the applications, they must buy and spend the native coin. It's like needing oil to drive a car or run a factory.
Okay, so utility demand, that's clear. What else?
The second is staking. In proof-of-stake systems, people lock up the asset to help secure the network. In return, they earn rewards, a bit like a dividend or interest. This act of staking takes a huge amount of supply off the open market, which can support the price.
So it creates scarcity.
It creates programmatic scarcity, yes. Then you have governance. In many projects, holding the token gives you the right to vote on protocol changes and the direction of the project. That has tangible value to people who want to influence the platform's future.
And I suppose there's this store of value narrative too, right? The digital gold argument.
Definitely. The belief, particularly for an asset like Bitcoin, that it's scarce, durable, and will be desirable in the future as a hedge against inflation or instability, that belief itself is a powerful driver of value.
Okay, now let's look at the dark side. Because we can't have this conversation and pretend it's all about utility and governance.
No, of course not. A huge amount of the day-to-day price action is driven by pure speculation, by hype cycles fueled by social media, and by things like artificial scarcity.
And straight up manipulation, right? We hear about wash trading.
Yes, absolutely. Manipulation is a big problem. Wash trading is when a person or group buys and sells an asset to themselves over and over again to make it look like there's a lot of trading volume and interest. It creates the illusion of activity to lure in unsuspecting buyers.
So what is the golden rule here for a listener trying to evaluate a token and figure out if its value is real?
You have to ask a few simple questions. First, who needs this token and for what purpose? Is there a real reason someone would buy this besides just hoping the price goes up?
And second,
The second, and this is the killer question, is why must this be a token?
why must it be a token? What do you mean by that?
Does this project actually need its own unique currency to function, or could it have just used dollars or Bitcoin or Ethereum? If the only reason the token exists is so the founders can sell it to you to raise money, that's a massive red flag. The token should be integral to the function of the application itself.
That's a great filter. Okay, speaking of red flags and numbers, let's talk tokenomics. This is a term you hear thrown around constantly. The tokenomics are good or the tokenomics are bad. What does that actually mean?
It's the economics of the token. It's the rules that govern its supply, distribution, and utility. And the biggest, most common trap here for beginners is something called unit bias.
Explain that one. I feel like this catches everyone when they first start.
Okay. Imagine token A costs $1,000 per coin. Token B costs just $1. The beginner looks at that and thinks, wow, token B is so cheap, it's a bargain. If it just goes to $1,000 like token A, I'll be a millionaire.
I see this constantly on social media. If Shiba Inu just goes to Bitcoin's price.
Right. But that thinking completely ignores the supply. If token A has a total supply of only 10 coins and token B has a supply of 10 billion coins, token B is never going to reach $1,000. There isn't enough money on planet Earth.
So the price per individual coin is almost meaningless on its own.
Completely and utterly meaningless. It's a psychological trick. The only number you should look at first is the market cap. That is the price multiplied by the circulating supply. That tells you the actual total value of the entire network.
So don't look at the price tag of one slice of pizza. Look at the size and price of the entire pie.
Exactly. And there is one more layer to this that separates the pros from the amateurs. You have to look beyond market cap to FDV.
Fully diluted valuation.
Right. Market cap tells you the value of all the coins that are available to trade right now. FDV tells you the value of all the coins that will ever exist in the future.
And why does that matter so much?
Because of inflation and future selling pressure. If only 10% of a project's tokens are circulating now and the other 90% are going to be released over the next year, that is a massive, massive wave of new supply that's about to hit the market.
And that's the emissions schedule, investing schedule we hear about.
Precisely. Vesting usually refers to tokens held by the founding team or early investors that are locked up for a period of time. When those tokens unlock, those insiders might sell, putting downward pressure on the price. Emission is just the rate at which new tokens are created, for example, through staking rewards. If you want to sound like you know what you're doing, don't talk about the price chart. Say, I'm looking at the supply schedule and the upcoming vesting unlocks.
I love that. I'm concerned about the vesting schedule for Q3. Instant credibility.
It really is. It shows you understand where the potential selling pressure is going to come from, which is far more important than the daily price wiggles.
Let's talk about security for a minute, because this is another huge paradigm shift. We mentioned earlier that your wallet is your login. This is a radical departure from Web 2.
It is the ultimate double-edged sword of crypto. In Web 2, if you forget your password for your bank account, you email them, you prove who you are, they ask some security questions, and they reset it for you.
Because they have the keys. They are the custodian of your account.
Exactly. In Web 3, with what we call a non-custodial wallet, you are the custodian. You hold the keys. You are your own bank.
Which is incredibly empowering, but it also means if I lose my keys, my seed phrase.
Your money is gone forever. There is no customer support line to call. There is no forgot password button. There is no undo.
That is genuinely terrifying for a lot of people.
It is the price of true ownership. It is absolute responsibility. But on the flip side, it also protects you from a bank freezing your account or a government seizing your funds or a company like Facebook getting hacked and leaking your password to the entire world.
But it opens you up to a whole different category of risks. Phishing seems to be the really big one.
Phishing is deadly in crypto because your wallet is used to sign transactions, which is basically just approving actions. Scammers are constantly trying to trick you into signing a malicious transaction.
Like a fake website that looks exactly like the real one, and it pops up a request in your wallet.
Exactly. You think you're signing a transaction to mint a new NFT, but you are actually signing a transaction that gives the scammer permission to drain every single asset from your wallet. Personal security, your own habits are everything. Any Crypto 101 guide is irresponsible if it doesn't emphasize that point above all else.
We'll probably have to do a whole separate deep dive just on security practices. But for now, the key takeaway is you are in control, which also means you are the only line of defense.
Correct. Trust no one. Verify everything. Click no weird links.
All right, we're coming into the home stretch here. One of the biggest barriers to entry in this entire space is the language. It feels like everyone is speaking a secret code designed to confuse you. I want to do a jargon translation guide. I'm going to throw a common term at you, and you give me the plain, simple English translation.
Let's do it. Rapid fire.
Okay, first one. On-chain versus off-chain.
Simple. On-chain means the action is permanently recorded on the public ledger, the blockchain. It's verifiable by anyone and irreversible. Off-chain means it's recorded in a private database or a spreadsheet, like the internal records of a centralized exchange.
Okay. Next up, bridge.
A bridge is a special application that lets you move your assets from one blockchain to another. Think of it like a ferry that takes your money from the Bitcoin island to the Ethereum island.
DEX versus CEX.
Cetix is a decentralized exchange. It's a robot market. You trade directly with a smart contract peer-to-code. You never give up custody of your funds. A CEX is a centralized exchange, like Coinbase or Binance. You are trading via a company, just like a stock brokerage. You deposit your funds with them.
How about liquidity and slippage?
Liquidity is just a measure of how easy it is to trade an asset without affecting its price. If there are lots of buyers and sellers, it's highly liquid. Slippage is what happens when liquidity is low. You try to buy an asset at $10, but because there aren't many sellers, your own purchase pushes the price up, and you end up paying an average of $10.50. That 50-cent difference is the slippage.
Rare drop.
Free money, basically. It's when a new project distributes its tokens for free to early users of their application or to users of a related protocol. It's a marketing tactic to bootstrap a community.
And the scary one, rug pull.
The worst-case scenario. It's when the creators of a project, who often are anonymous, suddenly withdraw all the money, the liquidity from the trading pool, and vanish. The value of the token instantly goes to zero, and everyone who bought it is left with nothing.
And finally, a term for a person, whale.
A whale is just someone who owns enough of an asset that their actions can move the market. If a whale decides to sell, the price will likely drop. If they splash around, everyone else gets wet.
You know, the funny thing is, listening to all those definitions, most of this is just normal finance stuff with a new name.
That is the key insight. That's the secret. Most crypto jargon is just traditional finance and software terminology that's been repackaged for this specific industry. Liquidity, market cap, yield, derivatives. These aren't new concepts. They're just being applied in a new, open and programmatic technological environment.
So we've covered a lot of ground today. We really have. We moved from that initial chaos and confusion of everything is crypto to, hopefully, a structured mental model.
Right. We have the operating systems, which are the coins, and the applications that run on them, which are the tokens. We have the security layer, which is consensus, either mining or staking. We have the brains of the operation, the smart contracts, which allow for all the cool stuff like DeFi. And we understand that fees are simply the cost of trusting a global, decentralized machine instead of a single corporation.
It really does make the chaos look a little more organized when you see it in layers like that.
That's the entire goal. Once you see the structure, the layers of the tech stack, the noise of the daily price movements starts to matter a lot less. You start to see the machine for what it is and what it's trying to do.
We mentioned that this is just the overview. In the future, we're going to need to do a dedicated deep dive specifically into Ethereum, because that's really where this wild world of DeFi and NFTs lives and breathes.
Absolutely. Ethereum is a rabbit hole all on its own, and we've only just scratched the surface of what's being built there.
But before we wrap up for today, I want to leave the listener with a final thought to chew on. You mentioned that so much of the jargon is just repackaged finance terms.
I did, and I want to leave you with a provocation based on that idea. If crypto is, in large part, just repackaged finance terms, then I want you to consider this. How much of the complexity in this space is actually technological? And how much of it is just a linguistic barrier?
A barrier that's designed to keep people out, or to make it seem more complicated than it is.
Or to keep the insiders feeling like wizards with a secret language. When you hear a complicated term, I want you to ask yourself, is this a genuinely new invention? Or is it just a fancy, new age word for a loan, or a vote, or a share, or a database? I think you'll find that often the barrier isn't the technology, it's just the language.
I love that. Demystify the words, and you can understand the money.
Exactly.
We'd love to hear from you. What is one crypto word you absolutely hate hearing? One that always trips you up or makes you feel like you're missing something? Let us know, and maybe we'll translate it in the next deep dive. Thanks for listening, and we'll see you next time.